My name is Rob Berger. I think I'm a little early, but I figured, well, might as well get the show started. I'm here, and a lot of you are too. So a thumbs up if everything is working. I think it's working. You'll let me know. I was looking at some of the comments before the show, and I hope I can keep some of them on there. I still got to figure out how I can see old comments. The chat keeps moving as the show goes on, and it's kind of driving me crazy. So a thumbs up, just let me know things are working. I'll get into sort of my spiel. I've got a topic that's going to be short. By the way, if you've already asked a question, remember to tag me. I see the thumbs up, James. Thank you. Do you mind asking it again? Because I'm not sure I'll see questions that are comments that you asked before the stream started. That's just a technological advancement that I've yet to conquer. So I don't know if the title of tonight's live stream is Buy and Hold Investing Impossible is exactly right, but I wanted to share just some of my current thinking. And it comes from, so I've really started in earnest. I've got a number of books I want to write, and I've started in earnest on the one, at least at the moment, that I expect to be the next one I publish. But the first one, by the way, is Retire Before Mom and Dad. That's the only book I've published so far. The next one is going to be about buy and hold investing, and I'll show you what I mean. So and I've said and written this many times, this idea of the power of compounding. You put your money in the S&P 500. If you did that 50 years ago, today you've got a big pile of cash. And we can look at it, right? This is Portfolio Visualizer over the last 50 years. This is US large cap, so basically S&P 500 from January, here it is, 72 to November 2022. And if you put in 10 grand back then, it'd be worth 1.5 million. And you've no doubt seen versions of this many, many times. The idea of the book is like, this is fine to look at, but how do you actually live it? How do you actually, if you're going to invest in this case in the S&P 500, how do you stick to it? And there are two problems, right? One is when the market crashes. So like, when you start out in 1972, you're up 19% the first year, you're probably feeling pretty good. But then you're down 16 and then down almost 27. And by the way, inflation is like 6% in 73 and 11% in 74. So on an after inflation basis, it's been brutal. And the reality is a lot of people, forget 50 years, a lot of people wouldn't have made it out of 74 without selling at least some of the that initial 10,000 that we've invested in this hypothetical scenario. Not to mention, by the way, the 3 bad years during the tech bubble burst, and of course 9/11 is in there. Not to mention 2008-09, and so part of the book will be describing ways, strategies, mindsets that allow us to live through events, without selling, right? Okay, fine. But as you start to write things, and I really encourage you, like even an investment plan, I think is a good thing to put down on paper, because as you actually start to write, it forces you to think about things, new questions come up, new angles, and sometimes it's difficult to really explain in writing your thoughts on this. At least I find that to be true. It really forces you to think through what you believe and why you believe it. One of the problems that I see with this pretty graph, right? We can talk about how to survive a bear market. And in looking backward, it's quote unquote easy because we know how it ended. We know how the 50 years ended. Even with this year that's down, we know that over the last 50 years, it's had a compound annual growth rate of over 10%. Right? What we don't know is what the next 50 years are going to look like. And what if over the next 50 years, the S&P 500 does terribly? I don't know what terribly means. Pick your bad number. What if the future doesn't look like the past? How do we have confidence enough that it will to stick to our investments? Or maybe we don't have enough confidence that it will, but we stick to our investments perhaps for other reasons. It gets into, I saw someone ask the question about international exposure. Why are people, a lot of folks, against international exposure? Well, because certainly in the last 10 years, and I would say overall, like we can actually look at it. We could put in, we could do global investment, excluding the U.S. market. We can compare the two, right? There are certainly periods when international has done better. But as you can see, and by the way, this doesn't go all the way to 72. It goes to 86 because there's a limit on data, but that's fine. You know, because U.S. is still at 10.62 and international is down to 6.5, which makes, as you can see, if you can read that, I know it's probably kind of small, makes a big difference in the ending balance, 415 grand versus 104. So we look at the past and we say, boy, that's not very appetizing. We're going to put our money in U.S. stocks, or predominantly U.S. stocks. And I've done that. I mean, I have international stocks, but my percentage between the two doesn't match the market, right? If I wanted to match the market, I'd probably just invest in something like VT. So why am I not matching the market? Well, if I'm being honest, it's because U.S. stocks have outperformed international. Again, not always, not over every reasonable amount of time, even 10 years, but long-term they have. And we can even put a narrative around why that is. While the U.S. government is more stable, at least compared to emerging market economies and governments, and we're more business, I think, oriented than a lot of economies. You know, we could talk about maybe natural resources. We could talk about education. We could build some narrative around why we've done better in terms of the stock market and business generally. And there's going to be a lot of truth in all of those things, whether though that means that the next 50 years are going to look like the last 50 years. That's a pretty big leap of faith. And it got me to the conclusion today, as I was thinking about this live show, is that the reality is we all have a breaking point in terms of that. So there could always be something that causes us to say, okay, I can't take it anymore, I'm selling. Now, it may not be selling everything. It may just be a dramatic change in your asset allocation. I think it would probably be foolish of me anyway to say, nope, absolutely nothing could happen that would cause me, you know, to sell a big chunk of my stock investments. And a lot of this, you know, goes into questions like the 4% rule when you're in retirement or you're near retirement. What should my withdrawal rate be? We can look at all the historical data we want to. They've gone all the way back to 1871. And that's useful and helpful. But it still doesn't tell us what the next 30 years are going to look like. And the reality is we have to make really important decisions, not knowing the future. That's just the reality. And each of us has to make a decision about how we're going to deal with that uncertainty. Some folks work longer. Some folks maybe buy an annuity. Some folks don't buy an annuity to deal with it, oddly enough. You extend and delay when you take Social Security. You know, there's all these different things. Or you retire, but maybe you work a part-time job. You downsize. I mean, there's, you know, probably an endless number of ways that we can try to deal with the fact that we don't know what the future holds. We just don't. And so as I thought about all these things today, I thought, to be honest with you, I thought, I don't know if I can write this book. What am I going to say about all that? I haven't figured it out yet. If you guys have any ideas, let me know. That'd be great. But to me, that's got to be part of the book. Part of the book is understanding stocks, understanding why they're valuable, understanding that there are cycles, understanding that there are going to be periods of time when they're down and down significantly, and they come back generally because business comes back. Business comes back because we need it to survive, at least in the kind of life that we know. Obviously, anything could happen. A climate disaster of a pretty significant nature, you know, I don't know, hacking and a major cyber war, nuclear war. I mean, we can all think of things that could happen, but beyond those really extreme events, you know, I think yeah, I can handle the book as it relates to just sort of getting over the typical cycles. Or, by the way, avoiding the ARKs and the Bitcoins and the Dogecoin and the meme stocks. That's the flip side, right? They call it greed. I'm not sure that's the right word, but fear of missing out is probably the better, I think, way to describe it. I think that's why a lot of people are still invested in ARK, by the way. It's because they think, well, she did it once before. The fund really did well once before. It can maybe do it again. In any event, I can handle those in the book, I think. It's this more almost existential kind of issue that, I'm working on. So, email me if you have any ideas. That's my topic for today. It sounds kind of depressing now that I've finished saying it. Oof. All right. So, welcome to the show. If you're new to the show, I do this every Monday, although I'm taking the next 2 Mondays off. So I should tell you that now. It's the holidays. I'll be back. We'll all be back, hopefully, January 2nd. So I am taking the 19th and 26th off. And I hope you do too, and have a good time with your family and whatever you do to celebrate the holidays. But if you want me to address a topic, try to put the @ in my name. It shows up. It's easier for me to find, as opposed to just you're bantering back and forth with other people in the chat. Just be kind. That's all I ask. This is not financial advice. I'm not a financial advisor. You want to ask my opinion on something, I am more than happy to give it to you, including whether or not the Ohio State Buckeyes can beat Georgia. Yeah. All right. So let's dive in. This is a great first question. I think it came in before. Yeah, it did. It came in before my little speech at the beginning. From Trapjaw. Assuming buy and hold is possible, how often should we peek at the portfolio? Well, that's a good question. I think, boy, this tea is not very good. I think it depends on why you're peeking at it and what effect peeking at it has on you. There are times when the market's down 3% in a day and I just say, you know what, I'm not going to look at it. It's not because I feel like if I look at it, I'm going to run off and sell. It's just like, I don't need the, I know it's down. I don't need to see the numbers. And if it's down several days in a row, I might, not look at it for a week or two. Yeah, probably a week. But so I think part of it depends on why you want to look at it and what effect it's going to have on you. Some people probably shouldn't look at it very often at all. All right, is it Natalie? Yes. How do you pick ETFs for a portfolio? What makes a portfolio with 6 to 7 ETFs more complicated than one with 2 to 3 ETFs? What specifically is more complicated? Those are great questions. So here's how I think through picking specific ETFs. The first question, it's kind of like, how do you pick ingredients for the meal you're going to make? Well, the first thing you got to know is what you're going to make. What's your recipe? What's it going to have? And so investing is the same way. What's your recipe? What's your asset allocation, right? So if you say, well, I want 40% in U.S. stocks and 30% in international, what is that? 70, and 30% in bonds, for example. That's the first thing before you even start thinking about specific investments. You need to have your recipe. What's your plan? And it can get, it can be as general as that. Some people get very, very specific. I want 7% in small cap value, and I want 12% in emerging markets, and 10% in REITs, and but that's fine. But you need to figure out what your plan is, and then you can just pick ETFs. So, for example, if you didn't know anything, let's imagine you didn't have any ETFs in mind, and hang on, let me clear this up a bit. We'll just go to Google. So Google wants to throw up all kinds of stuff on my screen, and I don't know why. So you might do S&P 500 ETFs. So something like that. Google S&P 500 ETFs, and you're going to get lists, right? Now you could go to a specific broker. So for example, if you knew your account was at Fidelity, you could go to Fidelity or Vanguard or Schwab. But you could look at like a Forbes article. And the thing that I look for, in this case, if you're using index funds, it's easy because you want an inexpensive fund that tracks an index. So here's a SPY, a very well-known S&P 500 ETF. It does have 0.095 expense ratio according to Forbes. I'll assume for a moment that's correct. That's too high, I think. Like here's iShares. It's just 3 basis points. Here's Vanguard VU, one we've talked about. It's just 3 basis points. So these would all be reasonable options. And you would just go down the list. Same thing with international and bonds. Now, there's over time, there's more to learn. There's really different kinds of bond funds and there's different kind of international. When I first invested in emerging markets, I didn't really know what they were. If I'm being honest, this was 20 years ago. I knew they were international, but I didn't appreciate the difference between emerging markets and developed markets. Developed markets being, countries with economies that are more developed. They're a little politically more stable and so on. There actually are, over time, different definitions of a developed country. But in any event, and you just map ETFs to your recipe, whatever you want. Now, the reason I would view 6 or 7 ETFs as more complicated than 2 to 3 is because of rebalancing, right? You've got more moving parts. It's easier to rebalance a portfolio that's got 2 or 3 funds than if you've got 6 or 7. So that's what I think about when I say it's more complicated. Hope that helps. So Natalie also has a question. I don't have an opinion. But I'll bring this up. So if you go to Treasury Direct, strips are like you could strip out interest payments from a bond. They call it stands for separate trading of registered interest and principal of securities. I've never bothered with this, so I don't have an opinion really at all. And EDV, is that I don't even know what EDV is. I'm guessing it's an ETF. Let's find out. Oh, it's just an extended duration treasury fund from Vanguard. EDV. Let me pull down the comment. Yeah, so if we go to the portfolio, you can see it's a very long duration bond fund. And it's, I think 100%, it's treasury. So it's 100% government bonds. So this would have a very significant exposure to interest rate risk because the duration is so long. Some might argue that they expect interest rates to eventually come back down. That's why the yield has been inverted as much as it has. And that, imagine fast forwarding a year or two from now, people would love a yield of 363 on long bonds. I don't know if that's what's actually going to happen, but that would be one argument in favor of just long bonds. Generally, this would just be one fund you could use to get that exposure. I've always just invested in intermediate term bonds, and some short term as sort of a cash alternative. It's just been where it's been my comfort zone. Kind of goes back to, what do you need so that you can buy and hold, forever, right? That's how I think of it. And for me, that was intermediate term bonds. Doesn't mean that there can't be a time when long bonds make sense. Maybe they make sense now. I don't know. I can tell you, because I was investing in the early 80s. By investing, I mean in certificates of deposit. And I was getting like I've mentioned this. I was getting like 16% on 6-month CDs. And you'd think, oh my goodness, Rob, what were you thinking? Go long, man, go long. Of course, we didn't know what the next 40 years were going to look like. And we were afraid to go long because we thought rates were going to just keep going up. No, you wouldn't lock into a 5-year CD, let alone a 30-year treasury bond. Are you kidding me? By the way, back then, I think they were still callable because U.S. government bonds were callable. I think that changed in the 80s. Anyway, so you think, well, man, if I ever got to a point where the yield was 15% on this thing, man, I'd just put all my chips into long bonds. Yeah, you probably wouldn't. Because if you try to imagine what kinds of things have to happen to get us there. By the time that happens and we're truly at a 15% or higher yield, we're scared to death rates are going to keep going up. We didn't know if the Fed was going to be able to, bring inflation to heal. It all makes sense in hindsight, but at the time, okay. Kokalti, I guess. I don't know. If you are invested in SCHD, which is a Schwab dividend/value U.S. stock fund, what would happen to your investment if that fund gets dissolved and stops its operations? Do you think that might happen? Well, I don't know why that would happen. It's hard to imagine that would happen, at least with a Schwab fund like that. I suppose anything's possible, but I honestly, I don't know what would happen. Like, would you just get cashed out? Could you? I don't know what happens when an ETF dissolves. What happens when an ETF closes? You're forced to sell or take liquidation proceeds, which can create a tax burden. That's according to NerdWallet. Has anyone actually had that happen? I need to put up a question for tonight's show. Maybe you could guys leave comments. What question should I ask in tonight's show? I don't know yet. I need to think of a good one. I meant to think of a good one before I started, but then life happened. How do you feel that your prediction of ending year around 4,000 on S&P is becoming true? Dinesh, did I predict that? I remember someone asked me to predict something, I think, and I just threw out a number. Was that my prediction? I don't even remember. Is it coming true? It's 39.90. It was actually up today. When I looked at it, it was down. I mean, I don't know. I'm kind of getting goosebumps. I predicted something. I am historically a very, very bad predictor, particularly with interest rates and inflation. So Travis has a great question that comes up a lot, actually. I get a ton of emails about this. Should you include your pension when determining your portfolio risk? This would allow you to be more aggressive since you have future guaranteed income. I get the same thing. How should you factor in Social Security or an annuity? My approach, well, first of all, I don't have a pension. But when I think about Social Security, same concept, right? Some folks say translate it into, get it somehow calculate its current value and treat that as bonds. I don't like that for two reasons. First of all, what a pain. That's number one. Number two is whatever guaranteed income I have, presumably let's assume there's still some amount of money I need from my nest egg, right? My investments. And I think that's really what should drive how you invest that money. Now, if because of your pension, Social Security, whatever, maybe you don't need any of your investments. You may choose to spend some on some trips or hobbies, but you can actually live off of your guaranteed income, in which case, yeah, you could absolutely be more aggressive with your portfolio if you wanted to, just recognizing that, in a really bad market, you may have to cut back on the travel and the hobbies, right? I would say anything up to about 2%, maybe even between 2 and 3%, if that's what you needed from your investments, gives you a lot of flexibility on how you invest that money. Once you get over 3 and you start to get closer to 4, and certainly if you go over 4, you got to be more careful, I think. And again, this is based on historical data. Who knows what the future holds? But the data going back to 1871 tells us generally, if you're going to need around 4.5%, you want to be somewhere between 50 and 75% in stocks. So I that's how I think through your question, Travis. Now, one thing I want to mention, let me see if I can find it real quick. Bogelhead's podcast. We had Bill Bengen on the show a while back. Well, the Bogelhead podcast just had him on the show. Well, this isn't it. Hang on. I thought it was just So I find in the Bogelheads, actually, I think a link to my interview. This is a link to my interview, but there was a more recent one. See if I can find it. The reason I want to bring this, I'm bringing this up. Oh, here it is. So here it is. John, who's a financial planner, and is that turning like? Did that just flicker for you guys? It did for me, anyway. One of the things that they said, I haven't listened to this podcast, but there was a point that was made. Let me see. It was on Twitter, I think. That kind of struck me as interesting. And I think John actually tweeted it out. Let me see if I can find it, and then I'll show it to you. Where is it, John? I didn't make this up, I don't think. Maybe I did. Well, you'll have to listen to the interview. In it somewhere, I think there's a point made where circumstances could suggest you should have less than 50% in equities. And I can't now remember or find the reason behind it. But there you go. So anyway, Travis, I kind of got off track of your question. But that's how I think about it. Any sort of fixed income. You know, I've been meaning to do a video on how you should think about whether to buy an annuity. I'm thinking single, premium immediate annuity. And if you should buy an annuity, how much? And there's one formula, a guy named Otar, if I'm pronouncing it right. He's got a calculator, a retirement planner, and he's written a book. His formula, though, I don't think it really works today. For one thing, he created it in a time when you could buy an annuity with an adjustment for CPI, and that doesn't exist anymore. By the way, when it did exist, everything I've read said it was a terrible deal. But that's what his formula uses, and that just doesn't exist anymore. Wade Pfau, Dr. Wade Pfau, who wrote a retirement planning book, which we've talked about, he sort of takes a different approach, and here's how he thinks through annuities. He says, take your sort of necessary expenses. Let's just assume, to survive, you need 50 grand, just to make up a number. And like Travis here, you've got a pension or you've got Social Security. We'll just assume it's 30,000. So that leaves you 20,000 left just to live on. But that doesn't account your fancy vacations and your hobbies and whatever. So the thought was maybe think about annuitizing that difference for what you need to have. That yes, in this case, 20,000. And that's fine, I guess, but it raises a couple of questions. First of all, you could buy an annuity today that would effectively give you 20 grand a year, but it's not adjusted for inflation. So that's a problem. And then even if we recognize that problem, the next question is, well, then what do I buy it for? How much? What do I assume? How do I even think through that? I haven't wrapped my arms around that issue yet. And then there's the other question of, but when do you have so much money that, relative to your spending, that just an annuity doesn't make any sense? I would certainly say if you're only spending 2% for sure, maybe even up to 3%. But I'm still thinking through that issue. By the way, why I went off on annuities, I have no idea. So Greg wants to know, when tilting portfolios towards small cap, should you go with the Russell 2000 or the S&P 600? I really don't have a strong opinion. If I remember correctly, the Russell 2000 is the smaller cap, right? So we've got iShares has a Russell 2000 ETF that is ticker IWM. So let's look at that one real quick. I'm pretty sure this is super small. Yeah, pretty small anyway. And then S&P 600, I need an ETF for that. Oh, that's Vanguard. VIOO. Let's look at that one. By the way, this is how I would probably think through the issue. This may be small too. I mean, as small. Let's see. So, yeah, so this is pretty much as small. I mean, we could come down here, by the way, and look at market cap and compare the two. This one's got an average market cap of 2 billion. I'm not going to go back to the other one, but that's how you would do that. Just when you come to this page, it measures. If you go to market cap, then you get this information. I do, because I generally prefer value. This one's a little more value. So of the two, I would probably pick this one for that reason. I haven't looked at any historical data, whatever. But I also probably wouldn't limit my choices to just these two. I'd consider AVUV, which is even more value. Again, the one downside to this is it's relatively brand new fund. So there's still a lot of uncertainty, and it's not a strict index fund. It's actively managed. I mean, I think they use, it's more of a quantitative thing. In other words, I think they're just using certain valuation measures and picking it, which is how they keep their expense ratio so low, 25 basis points. But if we go to the portfolio, yeah, it's even more value. Little bit larger companies, but not by much. 2.3, 2.4. So that's how I think through the issue. They would all probably serve the purpose, though. Vinyl makes the point that the S&P 500 consists of entirely different companies today than it did in 1972. That's, of course, true. I'm not sure the point. I mean, maybe is your point that you're not really a buy and hold investor because, yeah, you own the S&P 500 index, but underneath that, it kept changing? I still would view that as buy and hold. But you're right. I mean, that's in some ways, that's a feature, right? Not a bug, right? Of an index. But it's true. They have changed significantly. Yeah. James said he bought and listened to Retire Before Mom and Dad, and he really enjoyed it. Well, thanks, James. I appreciate that. All right. What do we got next? Oh. Charles wants to know what I found to be the hardest aspect of writing books. What about the most rewarding or most interesting? So my first book, writing can get tedious. There's a big part of writing that for me is tedious. It's not like you have this muse and just the words come pouring out. I mean, some writing sessions are better than others, but it can be tedious. And I'm constantly concerned about mistakes, not typos. I mean, those matter too, but mistakes in math, mistakes in concepts. Did I not think about everything? And that can be, I mean, I guess I'd use the word stressful. What I find the most rewarding right now is the books I'm writing now, and in particular, the one that I'm focused on, is going to be significantly different than Retire Before Mom and Dad. Retire Before Mom and Dad, a lot of it is sort of just very practical, down to earth. How do you build wealth? A lot of it gets into personal finance, managing debt, managing your investments. It's not, and it was designed that way. The book I'm writing now is going to have a lot more research to it. It won't be super technical at all, but it is going to have a lot more research and references to other work. And I find that to be a lot of fun. Like as an example, today, I'm reading The Psychology of Money by Morgan Housel, and there will be parts of that book that I'll reference in my book because I think they're very valuable. I'm reading a book called 4,000 Weeks, which is a wonderful book. It's, I guess you'd call it maybe it's an anti-productivity book. I'll show you the book on Amazon. Here it is. 4,000 Weeks, Time Management for Mortals. And the 4,000 weeks, that's sort of the average lifespan. You get 4,000 weeks. I really enjoyed this book so far. And there will be aspects of this book that I'll be referencing. And I really enjoy that aspect of writing. My approach to writing now is very, very different. I'm not like, okay, page 1, let's start writing. I have an outline, and I'm basically reading, and I see ideas. Okay, yeah, that's really important. It's going to fit in the book here. And so, and then I keep reading, and so I'm sort of slowly filling out this book as I read and think of ideas and try to connect different concepts. And so that's been very rewarding. It's rewarding to see my book sell. It's done pretty well. If you're thinking of self-publishing, which is what I did, and I'll probably self-publish the next one. I've talked to an agent because of, honestly, of this YouTube channel, and because of my newsletter. I could sell the book to a publisher, and I would, unless the book is just a runaway hit as a self-published book, I would make more going with a publisher, because the way that would work is they would give me an advance, and then future royalties would be offset against that advance. I wouldn't have to give it back, but I wouldn't get any additional royalties until the book sold enough to cover the advance, and the vast majority of books never cover the advance. But still, I would probably make more. The downside for me is that I was just looking at my orders for this month. Like this month, I'll probably sell between 300 and 500 copies amongst all the different, Kindle, paperback, audio. And that's pretty good. That's, well, I'm thrilled with it. That's, December is usually the best month because people buy it as a gift. In any event, the problem with going through a publisher is not finding one that's interested. It's that once the book's done, I'm at least another year away from seeing it released. I don't know that I want to wait that long. Speaking of buy and hold, Dan wants to know if it's a good time to move some of his TIPS fund to a short-term bond fund. Well, I guess the question is, why are you doing that? You've decided to make a change to your asset allocation plan. Why? That would be my question to you. So Mike says, in reference to that question about the Russell 2000 or the S&P 600, that we should use Avantis or DFA, Dimensional Fund Advisor funds, because they will minimize low profitability growth stocks that really hurt small cap returns. Mike, that's the theory. You're absolutely right. That's the theory. Let's think about this. DFA, small cap value. I really need their mutual fund, right? Because their ETF hasn't been around that long. So what is their mutual fund? Do they have a small cap value? Here it is. What's the ticker? I'll show you this in just a second. What? That's an ETF. Here we go. DFSVX. Let's see how much data we can get on this fund in Portfolio Visualizer. We'll go, oops, that's not what I wanted. Go here, put the ticker in. Oh, 94. Okay. So what were we looking at? Was it VIOO? What's that? Yeah, small cap 600. And then what was the iShares? iShares was IWM, right? IWM. Here we go. Let's just look at these two, because Vanguard's not going to, it's still pretty good. No, what'd I do? Hang on. We'll put in IWM now. The problem is going to be data. What do we get? Oh, yeah, 2011. Yeah, that stinks. Vanguard is the culprit. For these, Vanguard actually wins out since 2011. Pretty handily. They're not only the highest compound annual growth rate, but the lower standard deviation. If we pull them out and just compare the other two to see if we get more data, to 2001, and DFA definitely significantly outperforms iShares, but who knows what the future holds. And Avantis is just so new. It's kind of hard, I own some of that fund, not a lot, but it's not like owning an index. You just got to keep that in mind. Someone Digger says, can't wait for the game. Go dogs. Dogs. No, it's Buckeyes. What's dogs? Dogs. Go dogs. Some team near Atlanta. I don't know. I've never heard of them. Okay. Yeah. It kind of reminds me of, so like when we beat Alabama the year we won the championship, going into that game, I'm like, oh, ugly. This is not going to be fun. And then it's like, wow, how about that? I'm kind of hoping for a repeat. I got to tell you, though, it will be another blowout if our defensive secondary doesn't show up to the game. Oh. JB Will wants to know my thoughts on a 6-month Treasury bill rather than a municipal bond fund for a large bond allocation, intaxable. Well, they're so different, I mean, municipal bonds have different risks. They have greater default risk, although generally pretty solid. And for a, depending on which you're going to do VWIUX, it's going to obviously have, I shouldn't say obviously, but I assume it has a much longer duration. Let's take a look. So you're going to have interest rate risk that you don't have. Yeah, this one I'm pretty sure is an intermediate term bond fund. Yeah, 5. So it's much longer duration, right? 6 months, going to be 6 months, but this one's 5 years. So that's a difference. On the tax side, depends on your tax rate and how much of, you're going to get state tax advantages too. Probably not in that fund, but you might live in a state where you could get a different fund. There's federal tax savings, so you just have to do the math on that depending on what your tax bracket is. And also, it would matter how much you're investing. How much are you going to get? It's not just the tax rate, but multiplied against what? So I would probably, I would think, in my mind, the way I think about it is I'm only going to use Treasury bills for the cash portion of my, even if I count it as part of my bond portfolio, it's cash that I want to keep on hand. Emergency fund, I'm going to spend it in the next year or something. I'm probably not going to take my bond portfolio as a whole and stick it in T-bills. That's not what I'm going to do. And if I can keep my bond portfolio in a retirement account, a traditional retirement account, that's what I'd prefer to do. If I had to have a large chunk of it in a taxable account, I personally would probably I'd go with a municipal bond fund, but I wouldn't be happy about it. At least if it was a large chunk, because I don't want that much in municipal bond funds. But I wouldn't put a huge chunk in Treasury bills and pay the taxes. I mean, I know you get the break on the state tax, but yeah, that's how I think about that anyway. Hope that's helpful. All right. I've got the first, let's see here. Most of you probably won't care about this question. Who will win the OSU game? OSU is the first option. OSU is the second option. OSU is the third option. And the dogs, the dogs. Hope I spelled that right. There you go. Okay. All right. By the way, I have a ongoing wager with a good friend who went to Penn State, and we bet on the game every year, and whoever wins has to take the other out for lunch. The thought being, yeah, your team lost, but at least you get a free lunch. Well, what a horrible deal I made. And so he and I are actually going out for lunch tomorrow. I got to pay for it. And we go to nice places. Like, we're going to a steakhouse. It's not like we're going to McDonald's and I let him supersize it, right? Anyway. All right. So Kenny wants to know, what will be your lowest allocation to equities as you age? At some point in the future, will capital preservation be more of a priority for you than total return? Happy holidays. Well, happy holidays right back at you, Kenny. What? 71% said the dogs? It's an outrage. Anyway, at least as I sit here today, so keep in mind that a big part of this question depends on what percentage of your investments do you need to live on. And for us, it's a fairly small percentage. So my answer would be very different if I needed 4% every year, for example. But right now, I don't see going below about 70%. But, and by the way, as you age, you will get to a point where, let's fast forward and imagine I'm 80. And I'm here on the show. I'm talking to all of you. I'm probably hunched over. I probably have gray hair by then. Anyway, at that point, assuming I'm still using a relatively small percentage of my portfolio, our portfolio, it becomes less and less important, actually, right? It doesn't become more and more riskier to have whatever 70% in stocks, because you've gotten to a point where your life expectancy is such that, how much longer, you live to be 100, let's say, you're still only 20 years out. So at some point, it maybe even gets easier. But at least right now, I don't see going below 70 right now. One way I think about it is just a comfort level. There's no rule of thumb here, but I ask, how long can we live on our fixed income? And of course, part of that depends on what percentage of your portfolio you need, right, every year. But like, if you get to the point where you can live for 20 or 30 years on just the fixed income, that's a pretty good place to be, assuming you're using, really safe bonds for your fixed income. Anyway, that's how I think about it. I got to end this poll. This is just ugly. I didn't vote, by the way. Maybe I should have voted. Okay. Well, this is an interesting one. So I've got on my list to do a video on HEDGEFUNDIE. Let's see if I have them in my notes. I don't think I do yet. Oh, I do. But all I have is HEDGEFUNDIE'S Excellent Adventure. I have nothing about it yet in my notes. So I have to look it up. I remember thinking it was kind of a bizarre portfolio. At least that's my recollection. I love the name of it, though. So it's UPRO and TMF, right? I don't know what those up. UPRO is what? Oh, this is the Ultra Pro. This is so you kind of leverage up the S&P 500. Is this 2x but this is not, this is on a daily, isn't it? Let's pull up UPRO on the ProShares website. Here's what I'm looking at. ProShares seeks daily investment results before fees and expenses. Oh, that's 3x the S&P 500. See that? But it's daily. See this right here? That's really important. So for example, what's the ticker on this investment? Oh, we got it there. UPRO. If we go to Portfolio Visualizer and we put in UPRO and we compare it to VU, right? You might think, well, every year the market's up, ProShares should be 3x whatever VU is, right? And then when it's down, it'll be three times worse. But that's how it would work, right? Well, it's not how it works. Here are the actual, you can see it. There's the actual returns. And sometimes it's, close. Like here, let's take a look at 2011. Well, the S&P was actually up. This went in the opposite direction, let alone not, 3 times the S&P. This time it is, it's pretty close to 3 times. So is this one. Yeah, it's even more. This one, again, the S&P was up, ProShares was down. So you've just got to keep that in mind. I just personally feel that all of this sort of, and I guess TMF, a bond fund, I don't even know what TMF is. And neither does Morningstar. Huh. I don't know what TMF is. Oh, it's a 20-year. It's a 3x 20-year Treasury. I just don't see the point in that. Whenever we get into this sort of trying to 3x the return on a daily basis, it just gives me the heebie-jeebies. I know that's not a technical term, but I just don't know the point of it. But I haven't studied the portfolio in detail yet. It is on my list to do. All right. Kevin says he's excited to invest in Vanguard low-cost ETFs. Excellent. I'm excited for you. So Runner wants to know, Runner Chris, are TIPS investments really okay during inflation? It appears VTIP is down during a high inflation year. Well, so they do adjust the principal balance by CPI. But TIPS also, like any fund, when interest rates go up, values go down. Over time, they will protect you from inflation. They are after inflation. The yield is sort of after inflation. You can think of it that way. But you will see times like this, rates go up, the value of the fund is still going to go down, at least in the short term. So well, this is breaking news. Sam Bankman-Fried was arrested by the Bahamian. I've been to the Bahamas. Authorities, you think I could pronounce it? Bahamian authorities this evening, after the United States Attorney for the Southern District of New York shared a sealed indictment with the government. So let's just make sure that's not made up. And Space Travel 1776, I'm not suggesting you made anything up. Although with a name like Space Travel 1776, that must mean something. All right, enough of the nonsense. Let's see. He's been arrested. How about that? 32 minutes ago, according to Yahoo Finance. Here it is. Let's get rid of all the nonsense. Well, that's fascinating. It's not, I mean, the timing is always surprising, but the fact that he got arrested is not at all surprising to me. I mean, by all accounts, the exchange took money from that belonged to their client or assets and transferred them to Alameda, effectively the hedge fund, presumably in some kind of loan that then the hedge fund apparently lost. The thing that I found totally bizarre was Sam's response to all of this. It was almost, I don't want to start using psychological terms, but there's something not right there. It would be like a Bernie Madoff, like, wow, it's really bad judgment on my part. I'm sorry. We're going to figure this out. I want to help. I'm going to figure this out. We're going to, it's like, well, no, Bernie, you took people's money. You stole people's money. So I'm not sure what you're pretending to figure out. Now, in the case of Sam, I guess we still don't know what happened, right? But at least by all accounts, he did some troubling things, right? Anyway, interesting. Karen says, I enjoyed watching your panel at the Bogelhead conference. By the way, that is all of the panels from the Bogelhead conference earlier this year are now available. If you just go to the Bogelhead site, you'll find them. I don't know if I can find them quickly. Probably not. But you'll find it. What was your biggest takeaway from the conference? If you have a safe withdrawal rate of 2%, what is an appropriate portfolio? Well, I mean, honestly, so at 2%, I think studies tell us just about any portfolio will work over a 30-year period. And we can actually go to, let me pull up Bill Bingham's paper, and I'll show it to you. So here are all the papers I'm tracking. This is in an app called Zotero, which is free. These are all the Bill Bingham papers. I need to add some more. This is his 1994 paper. Here it is. So I'll just show you, let's just look at these charts. So this assumed a 3% starting withdrawal rate with a 50-50 stock bond allocation. And the portfolio survived 50 years, not 30, 50, for every period he examined, which was retirements beginning in 1926, all the way through retirements starting in 1976. Keep in mind, he wrote this paper in 94, so some of those retirement periods would have gone into the future. So he didn't have historical data for the ends of certain time periods, that started around here. So he made some assumptions, but everything else is based on historical data. This, by the way, is 4% withdrawal rate, but he had another chart in here that I want to show you. This one. So this second section, I don't know how well you guys can see this. Hopefully you can see it okay. This second section of bars here is for a 2% withdrawal rate. Maybe you can see that at the bottom of the chart there. And there's five, you can see there's 5 individual bars that each represent 0 stocks all the way up to 100. So 100% bond portfolio at 2% withdrawal rate lasted under 40 years, probably still close to 30, maybe even more. But every other stock allocation lasted the full 50 years. So again, we're basing this on historical data. The other thing you could look at is FI Calc, which we've talked about in the past, but I'll pull it up real quick. So it's everything's slow. It's like, is it the site? Is it my internet? I hope I paid the bill. I think it's the website. So here it is. We'll just leave this allocation alone for a moment, but we'll start at 2%, which would be 20,000 on $1 million portfolio. And you can see it's 100% success rate. We could take this to 50 years, still 100% success rate. Now, you could then, let's zero the cash out. Let's put, I don't know, let's make this 70 and this 30. By the way, this is including some annual fees. It would be assumption you're using index funds. Still got 100% success. So again, this is historical data. No one knows what the future will hold. But I think if the concern is a portfolio that will last, at least based on these tools and Bingham's paper and historical data, just about any allocation, maybe not 100% bonds, but just about any allocation seems to work. Now, you may have other goals, legacy goals, and that could change things. But my biggest takeaway from the conference, I'm trying to think, it was a lot of fun. Meeting a lot of you guys was the highlight for me. I learned a lot about Social Security. I am going to have Mike Piper on the show. I just need to do it, but it'll be after the holidays. That was probably the most eye-opening for me. I have 3 adult children. What would you tell them on how to save for retirement? They all would like to retire early. Well, of course, it depends on what they mean by early, but I think early retirement begins at a savings rate of 20%. If you're young, if you're in your 20s, maybe early 30s. Now, you're not going to retire super early at 20%, unless you really cut back your spending after you retired. But to me, that's the starting point, and it goes up from there. Now, yes, so the first question is, do you really want to retire early? And I think part of the thing I would be talking about is, let's imagine you retire at 50, right? What do? What's your life look like? Now, if you're 25, I don't know how you answer that. I couldn't have answered that at 25. Heck, I'm 56 and I'm not sure I can answer that half the time. But I think that's important, because a lot of the people that I know that have retired early, they're very sort of goal-oriented, they're driven, people. And maybe I fit into that category in some respects, I guess. But we don't retire easy. And the person, like, I have a good friend who plays golf 5 days a week. He loves it. That's just not who I am. And so you could say I worked really hard to retire, only not to retire. Now, I have a very lifestyle friendly business, and that's important to me, very important. But it's probably not fair to describe me as retired. So I would be having those discussions too. I think a lot of people, they look forward to that. It's a goal. And then when they accomplish it, it's kind of like, well, now what? It's like they need another goal. It can't just be reading novels or going to the beach. And so there can be some regret in the early retirement community, by the way, but not everyone. Some people just love it. People go off grid, or, they really pare down their spending and just love that sort of lifestyle. So a lot of it depends on personality and what you want. But from just a numbers perspective, if you're in your 20s, at a minimum, you should be shooting for 20%. That may not happen immediately. You may have to build up to it. But I think that's what you're going to need to do. Anyway. I see here more comments about Sam. Neil says the feds went to Bermuda. Maybe this is going to sound terrible. I don't know. Maybe not. But I'm glad he got arrested. I was tired of him acting like he didn't do anything wrong. Now, he may not have done anything wrong. I firmly believe in innocent until proven guilty. But from everything I've read, he's got a lot of questions to answer, and others will too, not just him. And it just bothered me. I would have just preferred him to be quiet, which would have been the smart thing to do, by the way. And his parents are both lawyers, but they can't. They don't speak for him. I mean, he makes decisions. Anyway, all right. Mike points out that AVUV is unlike ARKK. Oh, I completely agree. ARKK, to me, I did a video over a year ago warning people about ARKK. I mean, the valuations of the companies that make up that portfolio were outrageous. And even today, I don't even know what they are now. They could still be outrageous, even as the fund has lost billions. Let's take a look-see. What's its PE? Oh, I got to go to portfolio. I mean, it's still got a price to earnings of 50. Are you kidding me? It's a ridiculous ETF. That's what it is. it gets me angry because of the way I see Cathie Wood selling it. And she has an approach that's like, we're just fighting for the truth. Really? What truth? She'll tweet about how, she's not her, but the funds are denigrated by Wall Street. Really? Who? I'm sure most investment banks don't give a one hoot about ARK. This is the kind of thing that gets me fired up. And I think about all of the money people have lost. And I suppose at the end of the day, we can only blame ourselves for our own decisions, but I think it's the kind of fund it's a marketing machine behind that fund, in my view. And it's sad. And now, by the way, it doesn't mean it can't have some crazy year. It is the kind of fund that could go up 100% in 1 year. But those kinds of funds are terrible long-term investments. All right. I'm done getting all fired up, at least about that. I've got to move on. UGA Digger, who made an appearance earlier in the show. Love the channel. Can't wait for the game. Right back at you on the can't wait for the game. And thank you for loving the channel. By the way, Noreen is not with us this week. She had other family obligations. Okay. All right. We've got another live stream question. This is an easy one. Not easy in the sense that there's a right or wrong answer, but did Sam Bankman-Fried, SBF, commit a crime? Yes, no, or don't know. Now, I know literally we don't know, but like yes, no, or don't know, meaning you really just don't have any sense of it at all, which is fine. There you go. That's the question. So Jeffrey, you must not have watched my video. I just put out a video on my thoughts on JEPI. I can tell you I would never own it personally, but if I were going to own it, like if I had to own it, like there was a new rule, everyone has to put 10% in JEPI, it would be in an IRA. It's paying out 10, 12% a year. There's no way I'm going to put that in a taxable account. And most of that is options premium. It's going to be an ordinary income. I did get a very thoughtful email from a viewer who disagreed with my video, which is fine. I read the email. I've not been responding to many emails. I just can't. It's hard for me even to read them all, which is great. I love getting them. In any event, I didn't really agree. I had some questions. I might respond to that person. But I just don't see, I don't see what need a fund like JEPI, fills or solves. I'm not at all swayed by the yield. The yield to me is meaningless. It's I could generate that kind of yield if I want to sell options all the time. I may end up less wealthy than if I just own the underlying security like an S&P 500 index. But you can just roll over options, every 4 weeks on an index and make tons of premium. But it doesn't make for a good long-term investment. Now, the one thing that's interesting is they are sort of actively picking the underlying securities. But I'm not a fan. It's a new fund. We'll see how it does. I'm going to keep an eye on it. But I did put out a video that kind of talked about my views of that fund, Jeffrey, so you can check that out. All right. Randy says he emailed me a question last week regarding in-plan conversions. I may remember that email. Let's see. Here it is. I do remember this email. Well, let me come back to what you're saying here. What comments do you have as I seek to? So I've never done an in-plan conversion. Or an in-plan. Here's what I think you're suggesting, and I could be wrong, is an in-service. So normally you can't roll over a 401k to an IRA while you're still working at the job. Some 401ks, they'll allow it. So what folks will do is they'll contribute after tax dollars to their 401k, do an in-service conversion to an IRA, and then put that into backdoor that into a Roth. And they call it a mega backdoor Roth. So that's what you could Google. I think that's what you're describing, but maybe not, because you're talking about taking it from a traditional 401k to Roth. Maybe you can do that. Maybe if you have after-tax dollars in your traditional 401k, you can convert it into the Roth 401k. If that's true, I've never read about that. You would just have to call, I think it's Fidelity. Just call Fidelity. They'll answer your question. Maybe you can do that. Can you do an in-plan conversion? Maybe you can. It's coming up. Well, here you go. Look at this. What I just found. Just Googled it. Welcome to your 401k Roth in-plan conversion guide from Fidelity. I don't know what TVA is. This might be something unusual. This must be something not normal. Maybe a different country. What's NB? Anyway, Randy, the short answer is it's not something I've ever dealt with before. I've never had the ability to do it. So that was a long-winded, convoluted way of saying, I don't know. Andrew, welcome from Canada. I've spent a lot of time in Canada. I've been in Whitehorse. It's cold. Toronto. Vancouver is lovely. Been to Vancouver, been to the zoo. Mostly all of that for work. Yeah. I flew into Whitehorse. It's 30 below. I rent a car and I'm snowed in. I'm going to be driving down to Skagway, which is in Alaska. And I drive to this hotel in Whitehorse and I pull up, to the parking spot, and I'm looking up. I'm like, looking down the row. It's like, and I may have told this story on this show, but there are outlets at the end of each parking spot. It's the weirdest thing ever. So I go in, go to bed, get up, come out, try to start the car, click. Of course, the oil's frozen. Yeah, you gotta keep it warm. So you plug the car. I went to the front of the car and there's a cord sticking out. A plug. Oh, okay. Boy, that was a cold week. Whew. Okay. So Michael wants my thoughts on Fundrise. I interviewed their CEO. What's his name? Ben Miller, I think. So you can check out that video. I think at the end, it's Ben Miller. At the end of the day, I'm just not, for me, I don't want to lock my money away that way and the fees. I think a lot of folks like investing that way, and that's fine. I don't think it's a bad thing per se, but it just, for me, I'm not sure the added complication, the extra account, the limitations on access to the funds, the fees are worth it. So I've ended up not doing any sort of real estate sort of deals like that. Plus, if it's in a taxable account, there's taxes. If it's going to be in an IRA, I got to set up a special IRA to do it. So, but you can check out the interview with Ben. All right. Rob Cathy wants to know my thoughts on long-term care. I think for us, it's going to be self-insured. I mean, the reality is there's a big limit to what long-term care insurance will actually pay, and caps on how much, the benefit. And it just, Didn't seem to make sense for us. I can see it making sense for others, maybe. All right. Can't believe it's 8:14 already. You guys are probably thinking, man, this show can't go faster. Can't go fast enough. But for me, it's flying by. So Winfred wants to know, if we just got a $10,000 inheritance. Sorry for your loss. Currently, 100% vet. I get $3,500 a month tax-free, and can allocate 800. I'm not sure what that means, but just generally speaking, the first question is, what's the money? What do you want to use it for? And when are you going to spend it, and on what? You know, if I had 10,000 and it was just for retirement sometime in the distant future, I would just include it in my overall asset allocation and divide it up based on whatever my investment plan is, and in index funds primarily, in my taxable account. But you know, your situation may be different. You may need to start using it to live on, or you may have some other purchase you want to make in a couple of years. So it really depends, at least as an initial matter, on what you're going to want to use the money for. That's where I would at least start thinking through the issue. So Ben says that one way to deal with the risk is to try to retire with more of a buffer than you think you'll need. Absolutely agree. No question about it. But, we can all imagine a situation where what would seem like a great buffer isn't going to work, because some event or series of events. And that's just life, right? I guess it's just life. But I agree, if you can retire and only spend 2 to 3% of your portfolio in year one and then adjust it for inflation and live the life you want to live, I think that's ideal. Then you don't have to worry about all the countless ways you can do spend down and, Geitenklinger versus, whatever. It doesn't really matter at that point. You can just keep it simple. All right. Let's see. Joe Burns asks, how do you do your budget for your yearly retirement account withdrawals? Work out all your expenses and add 25%. Wife and I retired this year. Well, so you do have to, I assume that add 25% is for taxes. You do have to factor in taxes, but that's going to depend on where the money's coming from, right? If it's coming from a traditional account, obviously it's all taxed. Roth, it's not at all. Taxable, it's going to be a combination. So it may or may not be 25%. But in effect, yes, I think what you've described is kind of what you do. So some would say take it out monthly, some take it out quarterly. When Bill Bengen did his research, now this was just research. He wasn't actually retired and taking out money. He just did it once a year. I don't think there's a wrong way to do it, at least among those options. Part of it comes down to, I think, just convenience and how you want to manage your money. I kind of like the idea of doing it on a quarterly basis. So, I can automatically have the dividends come out, at least in the taxable account. And then whatever I need beyond that, it's going to depend on which account it comes from. I can sell shares if necessary. I kind of think of it on a quarterly basis. And if, you will have to think about estimated taxes, right? Depending on your situation, but yeah, that's kind of how you do it. That's it. All right. Kevin is excited for Jerome Powell's big speech on Wednesday. I guess, I don't know. By the way, 65% of you think Sam committed a crime. 34% say they don't know. 2% said no. That sounds about right to me. I would say yes, would be my guess. I didn't vote. I don't think I can actually vote in my own poll, which seems wrong. Based on what we know, I don't know how it's possible. I can't think of a way in which, at least in a reasonable way in which he didn't commit a crime. It's just hard to imagine, given his position, that he wouldn't know that funds were diverted from the exchange to the hedge fund. Although I suppose maybe it'll come out that funds were never diverted, but at least by all accounts, that's exactly what happened. And my hunch is there's going to be all kinds of things. There's going to be wire fraud, possibly mail fraud. I mean, there's going to be all kinds of crimes that are at least in play. So that's of course, we're still all, at the end of the day, we're still speculating. But isn't it fun? Okay. Maybe he didn't commit a crime. Maybe he didn't. What I'm finding interesting are like the folks like Mr. Wonderful, who was a spokesperson. I guess he was paid $15 million, which I got no issue with at all. I mean, I have no reason to believe that and you got Tom Brady and his ex-wife and all these different celebrities. I mean, I can't imagine any of them knew anything about what was going on behind the scenes with money moving around. Why would they know anything about that? The bigger issue for Mr. Wonderful, because I really enjoy sort of following him. I think he's a very smart guy. I enjoy listening to him, and I agree with a lot of what he says. But his love affair with crypto, I don't understand. This is a guy that says, don't hold more than 5% of any one investment because you want to diversify. Never buy a stock that doesn't pay a dividend. That's his view. And he's in crypto. It's an interesting. I can't reconcile those two things. Not that it matters. I guess, he's got a lot of money. He can afford to lose some of it, although I'm sure this hurt. Well, this is interesting. So Marcus says international funds are showing a 4% yield. Really? I mean, I haven't even been tracking that. I wonder what the yield is on my fund. We'll look up VXUS. Oh, yeah, well, the 12-month yield, they don't have an SEC yield. I don't know why, but it's 357. I mean, I do have an international fund, not this one. I have, hang on. I have, I can never remember the ticker. I'll tell you in just a second. I will tell you in just a second. Here we go. Maybe. Here it is. We pull it up on Morningstar. This is the one I own in a taxable account. It's got a trailing 12-month of 3.4. Yeah, I mean, in an ideal world, I wouldn't own that kind of fund. And it's not the end of the world, but it's certainly on the line for me. I'd rather keep it in a taxable account if I could. But, the reality is, like, we look at an S&P 500, we say, well, maybe that's what we should own because it's only what? 1.2? Has it gone up a little this year? What's the yield on VU, let's say, is 1.5. But, next year the yield could be over 2 or, 2.5, depends what prices do, So at some point you do the best you can. So Sean wants to know, for my bond portfolio, what percentages are in bond funds versus individual bonds? The vast majority are in bond funds. I own 5 I bonds. My wife and I do. And then I own some Treasury bills for cash. And that's it. So the rest are in basically a Vanguard Total Bond Fund. I am going to be making a change where because I'm using a balanced fund right now, kind of experimenting with it to try to simplify my portfolio. I'm going to move away from it. My asset allocation won't change. It's just not, it doesn't allow me, it makes rebalancing harder. Not because I have to rebalance the balanced fund, I can ignore it, but then it doesn't leave me other non-taxable options for rebalancing. And I want to have more tips, which is not an option for that. But it'll still all be intermediate term Vanguard funds for me. Oh, this is a good one. We got a good, we don't have a whole lot of time left, but we're going to do another poll. Here we go. How much, I don't know if people are going to want to answer this. How much have you lost in crypto? What are the choices? Well, none would be the first choice. Well, that's what you put in there. Less than 1,000. Okay, less than 1,000. And then we've got what? 1,000 to, we'll say 10,000. And then 10,000 plus. You guys going to want to answer this? It is anonymous. Like, I don't see how you guys vote. In fact, I'll show you what I see. This is what I see. No one's voted yet. Maybe oh, there we go. Wow, look at you guys. 94%, none. Okay, that's a good question. Can't believe the show's almost over. I'm just scrolling through now. All right, here's a non-financial question from Ram. Take a few minutes to tell us what apps, software you are using to reach into your quiver these days. Please speak their names slowly and or repeat for foreigners like me. Okay. Well, the one app that I probably use the most in terms of taking notes is Tana, T-A-N-A. You have to wait for an invite. I had to wait a couple of weeks. Here's the site. It's tana.inc. And what I like, there's a lot I like about it. This is what it looks like. And so I mentioned I've got HEDGEFUNDIE'S in here, but no data. One of the many things you can do is you can tag something, right? And I just created this tag, lazy portfolio, which in and of itself, is not unique, right? A lot of note-taking apps you can tag, but you can then configure this tag. So I could create fields in this tag. So I could say, okay, I'm going to put in here a field for the, what do I want to say about a portfolio? Maybe the source, right? And this is going to be the person who's behind it. And there's a lot of ways you can configure this. I mean, I can say, well, this is going to be an instance of a person. And then I can define person, and I could then have I could have a URL, let's say, and here I'll have a link to more information about this particular portfolio. I could add fields for stock and bond allocations. I could do whatever I wanted. And it just allows for, and I've just scratched the surface here, but it allows for a lot of creativity in the way you organize your notes. I probably need to go through and delete some of that, what I just did. Like I'll put in here, like I mentioned, predictions, right? I track predictions. So this is my list of predictions. I don't have a lot of them in here yet, but for each prediction, I've got the URL where I found the prediction. I call him the fortune teller. the person who made the prediction. And then I set a reminder for me based on usually when they say the prediction is going to come true, when Bitcoin will reach $1 million or whatever. And then this will show up when I get to January 1 of this upcoming year. I'll see this in my today note that comes up when you open the app every day. This just gives you an example. What other apps? I use Zotero, which I mentioned to you. It's this one. This is what I keep all of my, basically anything I can get to a PDF. So it could be a academic article. I can PDF a website article. And then I can copy this into the Tana app with all of my notes. Like I can take, like if you look at the Bill Bengen app, you'll see I've got highlights here, right? Well, those highlights get pulled in here. And then it's very easy to take all of this and move it into Tana. So that's Zotero and Tana have been a great combination. What other software apps do I use? So, I mean, on the programming side, I'm back to using Get, which I haven't used in a couple of years, but I'm doing some programming on allcards.com, and I'm going to use version control, which I'm not an expert at all. But so I use Get and a variety. I use Atom for my editor. You guys probably don't want to know all this. I've probably gone down into a deep, deep, dark hole that no one cares about. In terms of retirement planning, I haven't decided what app I like. I'll tell you, it's incredibly time consuming to use the apps and understand them to a point where I think I can make a useful video for you guys. I am working on MaxiFi, which I like a lot so far. One of the interesting things about MaxiFi, and I'll just show you the app. It's the MaxiFi Planner. Here's the website. Is that unlike just about every retirement planner I've used in the past, you don't actually come up with a budget. The planner doesn't ask you how much you're going to spend every year in retirement. Instead, it takes all the other data and says, here's how much you can spend. This is your limit. How you go about spending it, it's up to you. But it doesn't ask you to put in some sort of budget number. And I really like that. This is the one part about new retirement that I find a little confusing, because they have a couple of options where you can pick a spending plan or max your spending. And the results always, I found a little confusing. I kind of like the way MaxiFi does that aspect of it better. But I'm still working on that. That's my next one. We'll have a video up. I don't know. Those are some of the apps I'm using in a variety of different contexts. It's 8:32. Well, I'm going to scroll down to the end here and see what else we got going on before I call it a night. Yeah, I am. Is it Praluna? I think it's Praluna. Yeah. I'm going to cover, there's a lot I'm going to cover. And yes, this is one of them. I've purchased it. I just got to do it. I will tell you that writing my book is my priority. And so, but I'm still going to be doing videos, and I'm still going to be evaluating the software. It's very time consuming because they're complicated programs and things. You get output that doesn't make sense until you understand the programs well enough to say, oh, I see. I got this result because of something over here. I will tell you one that I've abandoned for now is Income Strategy, which I suspect could be a very good tool. But it's not an exaggeration to say that the help documentation is the worst I've ever seen. It's effectively non-existent. It's useless. And what you end up having to do is pay them an hourly fee to explain how to use their software. And I've bought their software. It's a monthly thing. I'm going to cancel it. For now, it's like, yeah, if you can't do better with the videos and the help documentation than that, I'm not interested. Even though I think it's a pretty interesting software. I may come back to it later. It's a disaster, though, in terms of the help docs. All right. Well, I guess that's it. It's 8:34, and I'm going to call it a night. I will. So the next 2 weeks, no live Q&A. Hope you guys have a great holiday and a great new year. I'll be back. Let's see. So I will be back January 2nd. That'll be 2 days after the Ohio State Buckeyes have hopefully beaten Georgia. But even if we get crushed, I will still be back, Lord willing, 7 p.m. on the 2nd. And yeah, you guys can let me have it. I guess before we go, we should look at the poll. 82% of you haven't lost anything in crypto. Good for you. I should ask, then the follow-up question would be, how many of you actually own crypto? You just haven't sold yet. 3% have lost over 10 grand. I'm sorry. But you probably haven't lost as much as Mr. Wonderful. All right, gang. Hope you have a great holiday, great week. See you in a few. Until then, remember, the best thing money can buy is financial freedom.